Good morning. It's Jeffrey Christian of CPM Group. It's about 11:20 here in New York on the morning of Friday, the 24th of October. I want to give you a brief update on the metals markets. They continue to be extremely volatile in terms of prices. In addition to that, the U.S. CPI for September came out today, and we'll talk a little bit about that. Gold prices, as 10 minutes ago, were $4,134.40. That was off about $12. Earlier in the day, the gold price had fallen quite sharply, something like $70 or $80. The spread this morning, as of 8:30, 9 o'clock, was about $100 or more. We've continued to see extremely volatile markets. After the CPI data came out, it's interesting because the gold price, which had fallen earlier in anticipation of a slightly higher inflation rate for September, when the data came out at 3%, basically, the gold price came back up some, and so it's paired a lot of its losses that it's seen. But we've seen a $440 swing in gold prices over the last week and a half, 2 weeks, and it continues to be extremely volatile. We have, in our ultra short term trade recommendations yesterday, said stand aside for Friday, and we'll see where the market is on Monday. We expected that the inflation data, when it came out, might have an effect on gold prices and silver prices, and it did. In addition to that, there are a variety of other factors, and we thought that there could be some investors who had been long who would not want to be short or long going into the weekend. So there could be some book squaring. From a technical chart perspective, the gold price has the looks of a measured move, which could lead to another $400 decline from around current levels over the next couple weeks, or it just as easily could mean that you break above it, because you have seen this very sharp trend line since late August tested this week, and it so far has held. So you could see some long building. Our view is that on Monday, we'll be behind the weekend, we'll be behind CPI, and we'll see where the price goes. And it's going to depend a lot on some of the political developments on a global basis and domestically. Both of them have some major changes going on that could affect investor sentiment in financial markets and move the gold price sharply higher or sharply lower. And we want to wait to see where we are on Monday. And that's our view for today. Silver prices similarly have risen very sharply since August. Then they came down sharply. They got almost to $54 last week, early this week, Monday, and they've come off from $54. They've gotten much lower. They probably got down to below $48 over the course of this week. They're about $48.41 as we speak. It's off about 29 cents from yesterday's close, but you can see it's down sharply, about $5.50 from the peak earlier on Monday. And we continue to, it's the same story as what we see with gold. We expect the price to remain very volatile. There are political, economic, and technical and fundamental factors that are going both ways in the market. We have seen a continued reduction in COMEX inventories. Registered inventories are down to about 160 million. Total inventories, including the eligible but not registered, are around 497 million ounces. The arbitrage between New York and London continues to favor buying in New York, selling in London, and shipping the material over. And that has resulted in this further reduction in inventories. We think that that shift is probably pretty much nearing its end, and that we'll see the arbitrage close up over the next week or two. But these are extremely volatile markets right now, not just gold and silver, but all financial markets, including stocks, bonds, and currency markets, as well as industrial commodities and agricultural commodities. So we expect continued volatility with an upward bias over the next 6 months. Platinum prices and palladium prices also have come off. As we were preparing this 20 minutes ago, the price of platinum was up about $2. It had fallen more sharply in the morning, but then it has come back since the CPI was released at 8:30, and it's up about $2.20. 20 minutes ago, it was up about $6 or $7 just before we started recording this. Our expectation is that the platinum price probably has less upside oomph in it than, say, gold or silver, because it is more of an industrial metal. And quite frankly, on a global and on a national basis, the auto industry, which uses the majority of platinum and palladium, is not in particularly good shape. You've seen only modest increases in auto production and auto sales so far this year. And you've seen an increase in market share of electric vehicles, battery electric vehicles, which don't use platinum and palladium. So you're seeing a relatively stagnant fabrication demand basis, and you're seeing some recovery of some of the losses that we've seen in mine production earlier in the year. So our expectation is that the platinum price probably is best traded on the short side from short-term investors. And very similar pattern in palladium. Prices have risen very sharply. They've come back off. They got up to around a little over $1,600 earlier this week, late last week. They're down around $1,490 today, having fallen even more sharply yesterday and this morning. Looking at the inflation, the U.S. CPI Consumer Price Index inflation index was released this morning. The blue line are the headline inflation, and you can see it bottomed out. It fell sharply from January through April, based on political developments that were causing skepticism and a reduction in expenditures by consumers as well as businesses. That changed and reversed in May, and we've seen a steady increase back up to about 3% on a headline basis. If you exclude the more volatile food and energy factors, we've seen that the consumer prices haven't really fallen as much. They did come down in January and February and March, but from March, April, May, they were relatively flat around 2.8%. That's because the oil price and petroleum energies, gasoline and heating oil, had fallen very sharply. You also had some weakness in food prices during that period of time. So while headline inflation did fall to about 2.3%, still above the target 2%, the core inflation, excluding food and energy, bottomed out at 2.8. It has since risen back up to about 3.1, and then this month it has declined. If you look at the big changes in the month, well, let's look at the month. These are monthly changes, and you can see that 0.3% increase in prices from August into September. Relatively high compared to the inflation rates that we saw February through July, down a little bit from August's figure. If you look at what was really going on, you saw an 11% increase in natural gas prices this month, the beginning of the heating season for one thing, but also some supply issues as the natural gas market has become increasingly internationalized. So you saw a big increase in natural gas prices in September. The other big increases that we saw were in medical services and in shelter housing. They both rose about 3.6, 3.8%. Other factors were relatively low. You didn't have a lot of prices declining over the course of September, but you did see a decline in several goods, not so much in services. Transportation services were a little bit weak. I wanted to leave this one thought. China reported that its exports to the United States plunged 27% from August into September, a reflection of the trade war and the imposition of tariffs by the United States on Chinese imports. Chinese total exports worldwide rose 8.3% in September after a 4.4% rise in August. In other words, China's exports continue to increase, and they're not going to the United States. The United States has been excluded from this, and China is finding that any number of other countries that are subject and targets of trade harassment and tariffs and problems with the United States, those other countries are shifting to buying things and sourcing things from China. China is finding a ready market globally for things that it's not sending to the United States. It also has not been importing things. Notably, China was our largest export market for soybeans, and it has not bought any soybeans this year. So the U.S. economy is suffering from these tariffs. The Chinese economy is suffering, but not as much. And it's finding ready compatriots to buy goods from China at the expense of the United States. That's all I have for now. You can go to our website. You can buy our yearbooks. You can subscribe to the monthly Precious Metals Advisory. There's a lot of free reads and videos there. You can send us a note at info@cpmgroup.com if you want to communicate with us about how we can help you better manage your exposure to precious metals and commodities and understand the economic environment. We have recently completed our third quarter long-term projections, 10-year projections for global economy, gold and silver, and are making that available to our clients that subscribe to that service. That's all I have for now. Take care of yourself. Take care of those around you. Try to do something good for the world, and we'll talk to you next week when hopefully there's a little bit better clarity on the direction of precious metals markets on the ultra short-term basis. On a short-term, medium-term, and long-term basis, it's pretty clear that gold and silver prices are likely to head higher. Platinum and palladium are more questionable. But on an ultra short-term basis, this volatility that we've seen over the last couple months now is likely to continue for some time to come. Take care.